Let's get across the market open now. Kyle Rodder joining us from capital.com. Kyle, welcome from London. Great to begin the week with you. Let's first take a look at obviously what's going on with Trump's latest trade policy. Obviously doubling the tariffs on aluminium and steel.
Yeah, I guess it shows that ultimately trade policy is driving the narrative still, and that really markets are going to be primarily driven by trade policy until there's an absolute resolution. Clearly, there was a little bit of a lull, maybe not so much in the middle of last week because we got those kind of threats towards the European Union, which were quickly resolved. But still, over the course of perhaps much of May, that there was this kind of complacency, perhaps that deals would eventually get done. There was that whole notion of a taco trade, which is Trump always chickens out, and investors were sort of feeling reasonably hopeful that the momentum was towards trade deals, at least if not deals, then negotiations, and investors could start pricing in some upside risk to equities. Of course, things are still looking reasonably robust. We're actually not far from record highs, and Wall Street on Friday night closed more or less flat, sort of looking for more news to kind of digest and drive the market higher. But it shows that ultimately the markets are still being governed by social media posts. That if something irks Trump and he feels as though there's being a sort of a lack of momentum towards a policy ends, he will quickly threaten tariffs, if not apply them with almost immediate effect. So obviously, again, we're going to sort of start the week, it would seem, on the back foot. We're already seeing futures off in the United States, the markets in the Asian region looking for a sort of a soft open, and yeah, a fairly significant day to week being kind of muddied now by further trade uncertainty.
Yeah, and obviously he also had a crack at China for violating trade agreements. But look, there is a prospect they're actually going to be talking this week, the two leaders.
Well, obviously we heard from Scott Bessent last week suggesting that there might be if not a gridlock, then certainly a sort of cooling down in momentum when it comes to negotiations, and perhaps tactfully suggested that the next impetus needs to come from discussion between the leaders, which looks like we might be moving towards. But as I understand it, at least this point in time, we've heard no confirmation as such. The problem here, of course, is that we're talking about a situation typically that takes a long time to nut out, or I should say trade deals take a long time to nut out. And there is the kind of complicated factor here that although we have a pause on the Liberation Day tariffs and the retaliation from China to those tariffs currently, there isn't sort of a clear set of parameters that either side are really working towards, other than a very general sense of arresting trade imbalances and maybe changing certain trade practices or policies, like say currency intervention or what have you. There's nothing kind of material that either side seems to be working towards that will sort of perhaps land a deal in the kind of quick order required to be able to satisfy the US president and his kind of whims, as well as China, who have obviously got long-term strategic concerns of their own. So it just shows that the kind of path towards a trade deal is potentially fraught with danger, that there's a lack of momentum at the moment. There's a hope that there'll be a meeting between the two leaders. But again, we're working towards an end that isn't entirely clear under a timeline that is fairly tight and under duress.
Now, we do actually have, in fact, we're going to hear from Fed Chair Jerome Powell this week. Last week, of course, President Trump lent on him, criticising, of course, for not cutting rates. Otherwise, data-wise this week, it's all about jobs in the US.
Yeah, it'll be tremendously loaded. So for the markets already dealing with this kind of extra trade noise, and you can even probably throw into that as well some of the uncertainty around US fiscal policy and the implications of that. There's the sense that the data might provide some kind of an anchoring point, and arguably, if you look at what economists are forecasting, perhaps a level of reassurance that despite the uncertainty that we're seeing, the policy by tweet or social media post by truth, so to speak, the economy is holding up reasonably well. The non-farm payrolls figures, early forecast suggests moderating jobs growth, but still in the realm of about 125,000 for the month, with an unemployment rate of about 4.2%. And those activity indicators that we will also get the ISM surveys are both in forecasts are indicating for both reasonably strong activity for the month. Of course, there'll be sort of a focus on the sub indices, the price sub indices, the employment sub indices, and probably new orders to get a better sense of the kind of growth / inflationary impulse that's coming through because of the impact of tariffs. But effectively, it's going to really drive, I think, markets from a sort of core fundamental point of view outside of the narrative that if the data comes in reasonably strong, even if we do get some of this turbulence and noise coming through from the tariffs, that it may soothe investors' nerves that the US economy is remaining resilient despite all of this. Of course, if we start to see some kind of chinks appearing in the data suggesting a growth slowdown, obviously the most disastrous mix would be also data suggesting that we might be seeing some persistent price pressures as well. That's going to compound some of these concerns again that are just continuing to simmer away from trade policy and trade rhetoric. So it really will be quite an impactful week. Of course, the first week of the month always high on tier one data, but one expects that we will see heightened volatility, not just from the news flow, but from the data flow as well.
Kyle, we also get interest rate decisions from the Bank of Canada. Also, the ECB. Look, you're in the UK at the moment. What's the sense you're getting in terms of on both sides of the channel there, particularly as far as trade with the US is concerned?
Yeah, the rhetoric is clearly one of fairly significant concern about the rate, the level of tariffs and how that will impact growth as well as the price level in this part of the world in particular. And it's a really difficult trade-off, obviously, for, say, the ECB, who've more or less achieved their mandate when it comes to price stability, not far off in terms of the absolute inflation number. But there's these growing downside risks to the growth outlook, really on the basis of the impact of already weak growth and then the effects of trade policy. But also that if we do see a kind of price shock coming through, that the economy is going to be wearing this kind of stagflationary mix, and that's going to be very, very problematic for the Eurozone economy in particular, as well as investors too. Effectively, the markets are pricing in that there will be a cut this week from the ECB. Economists are kind of calling that there needs to be a more sort of dovish tilt, and the markets are pricing in another couple of cuts after that at the back end of this year. But once again, policymakers and everyone, investors, are dealing with such a uncertain environment that the sort of distribution of risks is so wide that it's very, very difficult to provide any kind of guidance with any confidence whatsoever. So there is that kind of damned if you do, damned if you don't element. It would appear that policymakers want to provide that reassurance, but without the real confidence to be able to do so.